When we talk of audit, what is it? What is audit? Why do we audit? There's a question. So this kicking start this whole session. We're looking at what audit is and why the need for audit. What has necessitated the call for audit. All right. So we're gonna be straight to the point and see how best we can make this interesting. So we're looking at difference between ownership and control, the agency theory, why auditing plays a key role in equalizing information asymmetry or information imbalance between directors and shareholders. Then we'll consider the merits and disadvantages of having an audit. And then there are some conceptual framework theories. We'll look at those ones, of course, not to spend so much time on the theories, but we want to look at them and then what is the expectation gap we've been hearing about? What is it all about? Okay, so let's kickstart. So somebody comes with a business idea, sets up a business. We call this person an investor, a shareholder. He needs some people to manage the organization. So these are the directors, the managers. They are the stewards. Now, as a shareholder, I need someone to check whether the managers are working in my interest as a shareholder. So that's why they call for this independent person who's got the expertise to check whether really management or directors are running the business free and fairly and to the benefit of the shareholders. And these experts we need to call upon are the auditors. These are the auditors. The auditors will come and check and see if things are working well. Now, as a shareholder or the principal, he's interested that his investment will be safe. He will get regular dividends on his investments. The capital is invested will grow and then maintain the value of his investment. These managers, the directors, they are the agents. They are the stewards. They're interested in their salaries and benefits, getting some big bonuses and also getting some share options, owning some shares in the company. And they're also interested by their personal success. If the share price increases, they think they've also been very successful. There's a story here I want us to look at. Adolf Bell and Gardner Means published their seminal work in the Modern Cooperation and Private Property in 1932. Now, in it, they stated that as corporations grew, the financing requirements made it increasingly difficult for individuals to maintain majority shareholdings. So shareholding became divided and fragmented among larger and larger numbers of individuals and other investing bodies. As shareholders became more diverse and diffuse, the one constant in the company was the management, and the de facto power thereby devolved upon them. Now, as companies grew in size and power, a relatively large amount of total corporate wealth became concentrated in relatively few huge corporations. Now, managers in these corporations were able to disperse company resources in the way that primarily suited them, such as through reinvestment or even enhanced pay rather than as dividends. Now, these companies had an impact on society as they were able to open or close factories and branches, thus influencing the lives of millions of people without any real form of democratic accountability. What is Bell and Means saying is that when shareholders grow, the constant you find, the people who normally do not change are the managers. And in that case, if you're not careful, these guys hold so much power, they will run the business to suit themselves, not you, the shareholders. That's the need for us to always find some independent party who will come in. That's the need for an audit. Now, ISA 200 gives the overall objective of the independent audit that we conduct in accordance with international standards on auditing. And it says the purpose of an audit is to enhance the degree of confidence of intended users in the financial statement. So we audit so that people will have confidence that the books we have audited, we have signed off, are in good shape. Now, it is achieved by we auditors expressing opinion and then on whether the financial statements are prepared in all material respects in accordance with what applicable financial reporting framework. In the case of most general purpose frameworks, that opinion is whether the financial statements are presented free and fairly in all material respects and they give a true and fair view in accordance with the specific financial reporting framework. That's audit. So audit is simply check the books in all material respects. Do they give a true and fair view? And do they conform to the reporting requirement we have chosen to use in recording or reporting our transactions? So like I said, directors are agents for the shareholders, and they must safeguard the assets of the shareholders, and they must account to the shareholders. So that's the role of managers. Now, why are audits needed? Like I said, directors are motivated to sometimes run the business to benefit themselves, not the shareholders. Shareholders want to see what is going on. Some may be remote. Somebody can be in China and still be investing in the UK. And so he wants to see the reality on the ground, what's going on. And again, it is impractical for individual shareholders to check the accounts. Some shareholders have no understanding of what the accounts are. So somebody should check it and speak to them and tell these shareholders that everything is okay to a large extent. Okay. Now, auditors also report on whether proper books and records have been kept and whether there are any weaknesses in the accounting systems that report the transactions or that produce the transactions. So the duties of directors of a company is that they must act in good faith to the shareholders. Good faith in the sense that they will promote the success of the company for the shareholders, not for the managers. All right. So the likely consequences of any decisions in the long term. So in doing so, they must have regard. If they want to run the business in good faith and to the success, for it to be successful for the benefit of the shareholders, they must have the following considerations. They must consider the following items. The likely consequences of any decisions they take, that managers take in the long term. So any decisions managers take, what will be the consequences in the long term? They must also give regard to interest of the employees of the company. And they must also consider the need to foster the company's business relationship with suppliers, with customers, with others. They must also consider the impact of the company's operations on the community and on the environment, and the desirability of the company maintaining a reputation for high standards of business conduct, and the need to act fairly as between members of the company. Section 172 Companies Act 2006. So clearly what they are saying is that they must act not only to benefit the shareholders, but to a very great extent to benefit other stakeholders apart from the shareholders. So there are some regulations which guides reporting and which auditors must sometimes give consideration to. So the company's miscellaneous reporting regulation 2018 sets out the item for strategic reporting, long-term reporting. So you sometimes see it standing alone as strategic report. It says this must be included in financial statement of all listed companies. Companies Act, or we look at section 172, right, of the Companies Act. Yeah, section 172 of the Companies Act also provides some detailed guidelines. Let's look at what it says. It says there is a specific requirement for boards to make a statement as part of their strategic report on how they have had regard to the matters as listed in section 172, like we looked at the consequences and the impact on stakeholders, so on and so forth. Now, the revised UK Corporate Governance Code, the 2018 code, also contains similar reporting requirements. Now, the requirement relates directly to corporate culture, and possibly for the first time, it directs directors' attention away from the previous imperatives of profit maximization and rather growing the business. So what they are saying is that when you want to run the business, make sure it grows. When the business grows, it affects other stakeholders. Other stakeholders benefit, not just the shareholders having their wealth growing. And these are some of the reporting requirements. There are additional laws under Section 173, which talks of director of a company must exercise independent judgment. 174 says he must exercise reasonable care, skill, and diligence. 175 says the director of the company must avoid a situation in which he has or he can have a direct or indirect interest that conflicts or may possibly conflict with the interests of the company. Section 176 of the Companies Act says the director of a company must not accept a benefit from a third party conferred by a reason of what being or he's being a director or he's doing or not doing anything as director. If a director of a company is in any way, Section 177 says that if a director of a company is in any way directly or indirectly interested in a proposed transaction or arrangement with the company, he must declare this to the interest of other directors. So there are more laws for directors, and especially listed companies are usually bound to adhere to all of these. Now, company and large companies as well. The value of financial information. So consider the value of reliable financial information to stakeholders in the company. So here we're not talking of just shareholders, stakeholders overall. Like we looked under Section 172 of the Companies Act 206. So look at the value of this information to potential investors, to regulators, HMRC, name them, to employees, to suppliers, to customers, to tax authorities. What is the value of information reported to these stakeholders? Now, directors must act in what a fiduciary capacity towards the shareholders. What are we saying here? They are placed in a position of trust that they will safeguard the assets of the company and they will run it to the benefit of shareholders. How do they do it? They increase the shareholder value and they pay them dividends. Now, the fiduciary relationship between the parties therefore places the owner's family on the directors to be accountable for any actions they undertake, and they should be transparent in all their dealings, in their reporting. What does the auditor do? Our job simply is to go check what managers have done, and then we gather evidence to prove that yes, the profits and losses they have reported is correctly stated, the assets and liabilities they have indicated in their books actually belongs to the company, and they have been correctly valued or shown at the correct values, and that any accounting entries the managers have used in preparing the accounts are properly recorded in the accounting period. Now, how do we do this as auditors? Go review the accounting systems, review the accounting controls, review the accounting records. Where you don't find anything meaningful, ask for explanations, and they have to provide you with explanations. If you need to get information from third parties, obtain it to support the review that you are undertaking. There are other benefits of financial audits. Now, auditors may be involved in what? Discovering weaknesses in the financial systems. They could also check whether companies complying with laws and accounting standards. And sometimes, in course of their work, they discover frauds or errors. Of course, that's not their role. It's management's responsibility to ensure that fraud is prevented and detected. But if in course of the audit you determine something like this, which is material, you need to actually report it. Advantages of an audit. The provider of finance. Banks will want to use audited reports to help them make informed decisions whether they should actually grant loans to this company. Now, it also helps to protect creditors. Audits help to protect creditors. How? When the audited report is provided, creditors can assess whether really the company is in a good position to pay them their their loans or their liabilities when due. So auditors will flag it out. Listen, these guys they can't survive into the next 12 months. So then the creditors will be on guard and check whether they have to continue giving them credit or they have to get their funds back or to be paid on time. It also reinforces financial discipline so that people don't overspend or hide some items liabilities. Okay. It also establishes credibility of the company. So an audited account will let people rely on these reports to take informed decisions about the company. So it tells you the company is in a good position. There may be shareholders who are not involved in the business and their interests need to be protected. So this is what the independent auditor will do to ensure that the interests of these shareholders are protected. It also provides reassurance to directors that the figures you have reported are reliable. And then it helps other government agencies like the HMRC in setting some tax regulations or helping them to follow up with their tax liabilities. So in terms of tax settlement, VAT liability settlement, audit helps these other agencies to ensure that their tax liabilities are settled in time and follow up on any taxations which are due to the government. Because of course taxes are based on the profits. So if the company has reported a particular profit, the tax authorities can rely on the audited accounts to calculate their taxes, which are supposed to be what? Paid to the government. Now, disadvantage of audit. Audit is only for compliance and does not assist management in running the business. Normally, they deal with past historic data. So it's simply like a red tape measure, red tapeism. The cost of the audit sometimes represents a non-productive expense. Money could have been used elsewhere. Banks, other lenders, including suppliers, can make their own conditions for lending and they don't need to rely on historical audited accounts. For example, banks will lend based on security and guarantees. They can monitor the performance of the bank accounts of the customer and they may require regular monthly management information. They don't need audited accounts. Suppliers will deal on a pro forma basis. Cash before I supply. I don't need your accounts to look at it. Just give me cash and I supply you until maybe they've established some trust with the company. Historical accounts, taking advantage of limited disclosures of little value as they can be up to 9 months old. So the report I'm relying on to give you loans is about 9 months old. It's outdated. Okay, so these are some disadvantages of audit. Other dimensions of financial audit. It is actually useful to company management. Operational audits are being undertaken to check whether management is following procedures appropriately. Compliance audit is also undertaken to check if rules of an outside regulator are followed diligently. And this could be done by an internal auditor, who is most likely going to be the employee of the company. So normally, even IT audit comes in here. When we say true and fair view, what does it mean? In terms of audit, the definition of audit, and the opinions that they express. True and fair view does not mean that everything is correct, everything is totally accurate, and they are free of errors. No. It means that to a very great extent, the accounts represent a reasonably fair position of the company in terms of the performance and then in terms of the asset liabilities and equities at the balance sheet date. So it's a reasonable assessment, not an absolute assessment. Reasonable in the sense that we don't look at everything. We look at material items. But if we were to have said absolute, it means we looked at everything. We can see that yes, correct. It's accurate. It's free from errors. But that's not what true and fair means. Okay. What are the rights and responsibilities of auditors? Auditors have rights to all information and explanation. They have access to company records. They have rights to receive notices of meetings and attend and speak at certain meetings, not all meetings anyway. They have rights in case of removal. They have something to say? They can make representations to stay on as auditors. They can attend meetings, not any meetings, meetings which they are required. For example, if you have a meeting to recruit somebody, why should the auditor be there? It's not within his remit. So he should attend meetings which requires him to be there. Yeah, which requires him to be there. If the company is planning on setting up another company, an establishment, expansion project in Dubai, why should the auditor be there if it doesn't really affect his work? Now, duties, they report to shareholders with the Companies Act because shareholders actually appoint them, so they report to them. Their responsibilities, they have statement on leaving. They can provide a statement, I want to leave, and they present this at the AGM. And they can resign if they think they are not eligible for the role they are being contracted to. There are some theories here. We want to just touch on them briefly, and then we look at expectation gap and we move on. And these are basic academic writings fundamental to this area. We have the theory of rational expectations. Limperg proposed that. And he says the work carried out by the auditor should be governed by the rational expectations of those who use their report. So, auditors must not disappoint those expectations. Remember, somebody is looking up to you and going to rely on your report, so don't disappoint them. So, further, auditors should not seek to raise those expectations by any more than the work they do justifies. Don't give them false hopes. Do what you are required to do. There's an expectation, reasonable expectation. Go according to that reasonable expectation. Don't fall below. Don't raise the bar too high to think that the higher I go, the more satisfied they will be. You may disappoint them. Okay. Then we have the philosophy of auditing, which is proposed by Maltz and Sharaf. They are saying that auditing is based on scientific logic, where the auditing process is a rational, again, reasonable, logical process of what? Examination, observation, and evaluation of evidence. That's what they're saying. Now, they have some 8 assumptions. I would love you to look at the core text and look at those assumptions. But this philosophy says it does not consider risk or accountability between parties. Yes. Then we have Flint, who also has this. He expanded on Morse and Sharaf's philosophy of auditing by looking at philosophy and principles of auditing. And then he proposed some 7 assumptions on the fundamental idea that auditing has a social benefit, and it is not simply a technical exercise for the purpose of regulation. So some beautiful theories there, you would want to further examine them. Expectation gap. Sometimes people think that auditors are supposed to do what? Discover fraud. So when something happens, they will say, but where were the auditors? Did auditors not look at this? Is that what expectation gap means? So you see that the public has an expectation, and then auditors also have a responsibility to discharge. Now, the expectation and what we are also doing, they may not match. So here it comes into question where they think auditors have not done their work well. Now, so there's a difference between what public perceives and what the profession requires of the auditing profession. Now, public perception are that auditors prepare the accounts. Auditors check everything in the books. That's what they think. Auditors find fraud. That auditors should take responsibility for the financial statements. The auditors must ensure that the financial statements are accurate. Everything is accurate. They must also give early warnings of any business failures. Otherwise, they will say, where were the auditors? But in reality, that's it. That's not what auditors do. Okay. Now, a lot of definitions have gone on this expectation gap. And so it has been split into two expectation gap. We have the reasonable expectation gap, and the performance expectation gap. Reasonable expectation gap simply talks of the gap between what society expects auditors to beat and what can reasonably be expected of auditors. So the society will have a very broader expectation, but reasonably what is actually expected of us. Then we have the performance expectation gap. This one deals with the gap between what the responsibility society reasonably expects of auditors and those it perceives they deliver or do not deliver. So we reasonably expect this from auditors, and we think they should have delivered this, and they did not deliver. They did not meet that reasonable expectation. So simply put, expectation gap is what the public perceives or expects of the auditors and what the profession actually requires auditors to deliver. Okay, there could be a gap there because we normally tend not to understand each other. Okay, wrapping up. Audit relevance. Regulators will require improved standard of information in terms of what? Accuracy and timeliness in order to protect investors. Banks play a role here. These are particularly applies to banks. Now, increased corporate governance have led to increased accountability nowadays and increased disclosure. We know what the rules-based approach is. Now, conflict between a rules-based approach to control audit firms and the UK and other countries which have adopted a non-legal audit framework based on self-regulation. And the two approaches necessarily conflict, which has caused problems where the US jurisdiction, who are more rules-based and compliance-based, let me put it that way, clash with non-statutory approaches to audit regulations. Now, the need for auditors to use technology and to develop new approaches to the audit of large multinationals and internet-based entities have also gained prominence nowadays. So audit can find itself in a fix, where in a rules-based system, they expect you to meet a lot of criteria, but in a principles-based, sometimes you can be flexible enough to run the show. Globally, it has gained grounds. The audit profession has gained grounds. Reliable financial reporting is promoting confidence and stability in the market. Markets need confidence and assurance that there's a strong audit function. So participants in the market can always be what? Rely on the on information provided. Investors, potential investors can make informed decisions so that once we have these books audited and the reports produced, we have some hope that the information is sound. It can help us reduce risk with the audit, with the investors or potential investors. We can reduce risk. Corporate failures have gone on. You've heard of Arthur Andersen's story, and when the audit failed to do what is required, Enron, the world of WorldCom, you know it. Talk of Barings Bank. Sometimes corporate governance failures, yes, but auditors played a role. Lehman Brothers. Okay, so corporate failures, particularly those involving fraud by senior management, reduces confidence and creates instability in the global market. And it also tends to encourage increased regulation, which may restrict market operations and encourage further deception. Agency theory is key to the audit profession. It helps auditors to hold management accountable to who? To the shareholders. All right. There are some issues auditors face in the world of audit. Now, problems faced by auditors and accountants producing consolidated financial information in compliance with an appropriate accounting framework where the component information is prepared under a range of different standards of quality and disclosures, especially when the parent company and the subsidiaries live within different accounting jurisdictions. It's sometimes difficult for you to match them up. Can you imagine you have a company with a branch in UK and another one in US, and they are all listed? The reporting requirement will be terrible. Auditors will be in a big fix to produce the consolidated accounts because UK have their maybe IFRS based, and US will have the US gaps, and you must blend them together into a group account. It will be a tough challenge. Now, the growth of internet-based online trading has also brought about some challenges to conventional audit approaches. audit firms are being increasingly required to carry out other types of assurance, okay, for clients which require lower standard of evidence than does the audit, and it creates some conflict of interest. The big four audit firms, they've hijacked the audit profession, right? PwC, KPMG, EY, Deloitte. Now, so other smaller firms are not able to penetrate. Of course, we are getting some others who are coming in. We have BDO, we have RSM, Grant Thornton, name them, and other audit firms which are playing key roles. All right. So these are some flowchart figures looking at the financial audit process. You may want to study this at your own free time. And then there are some questions here where you would want to look at from the Millichamp and Taylor core text on why auditing and why the need and what is auditing. Okay. So we want to end here and then we'll catch up in the other session. Thank you. Bye for now.